Welcome to the Diginomics Brownback seminar. Today, I am very delighted to welcome Dr. Otto Kässi. Otto obtained his PhD in economics from the University of Helsinki. He is currently a researcher at ETLA, the Research Institute for the Finnish Economy, and he is a research associate at the Oxford Internet Institute, which is a department of the University of Oxford. His research concentrates on digital platforms and gig work, and Otto has published his work in high-ranking journals, for example, the Journal of Human Resources and the Journal of Management. And a really nice and important project he, among others, initiated is the Online Labor Index, which is the first economic indicator measuring the activity of the global online gig economy. Today, Otto will give a talk on the labor market effects of service offshoring, synthetic control approach with high dimensional microdata. And Otto, before the floor is yours, thank you so much for being here. And we are very much looking forward to your presentation.
All right, Eliza, thank you so much for the kind invitation, and thank you to all the participants. I can't exactly see how many of you are there, but thanks anyways for taking the time. I also don't have the visibility into the chat window, so please just shout out if you have any questions or comments, or if you can't hear me, or if I fail to explain something. So this is a paper I study offshoring. So paper about offshoring. Kind of like I guess the idea, the idea is like whether if all the jobs that we have are done in India, what's going to be left for us? This type of a narrative has been around for, I don't know, as long as I've been following economic writing. Basically, the idea is that, like on broad strokes, the discussion is that maybe offshoring will lead to local job losses, or especially for the kinds of jobs that are being offshored, while at the same time deciding not to offshore, the companies might then lose on their competitiveness, and which then again might lead to unemployment on its own, right? On the management literature side, it's been highlighted that while offshoring can bring huge cost benefits, at the same time it's kind of a big investment on the firm side. They need to invest in different types of skills. They might need to invest in different types of capital, etc., which in turn would have their own effect. So a lot of talk still, far from being a topic that where we have like clear predictions from the data. What I do in this paper, I study the effects of offshoring of services on wages and employment using I use Finnish registry data. We have access to a data set that covers the full universe of Finnish firms, and that's linked to the full universe of Finnish workers who work in those firms. And we also have a separate representative survey that was done by Eurostat that studied whether or not firms are offshoring service, or whether or not they started offshoring. And in the interest of not like, since this is a digital economics seminar, in the interest of not losing your interest on the first slide, I also need to highlight two things where I think this links back to the digital economy discussion. So first, I study services offshoring specifically. So one could argue that, like, in the absence of digital communication technologies, we wouldn't have the offshoring of services. In practice, all of these jobs, all of these services, they're actually transacted, how they're delivered to the offshoring company, the company that does the offshoring, how the work is sort of like, in quotes, delivered there. It's almost always, it's in practice always delivered by digital means. Moreover, as Eliza mentioned, one of my other sort of like research interest has been the gig economy, or rather platform-mediated labor. So to the extent that platform sourcing labor, sourcing offshoring tasks on labor platforms, it's only one facet of this services offshoring phenomenon. It's been growing on. It's been basically showing double-digit growth rates over the past 5-6 years, and to the extent that that's growing, then whatever we learn from this data that studies traditional offshoring, I mean, we could this might give us some hints on what the effects of platform sourcing or platform offshoring might be on firms in the future too. That still remains a relatively small share of the total offshoring, but still something that's been growing quite a bit. As regards to lit review, I'm just gonna mention some of the relevant previous papers. So first of all, a large chunk, I would say the majority of the previous papers that at least the more prolific ones, they talk about offshoring, but what they really do, they discuss trading goods, like something that was previously procured from local markets, say an intermediate good, it's now procured from abroad. So you could think of like the intermediate goods coming from China replacing intermediate goods that were produced in the same commuting zone or in the same area. So that only looks at trading goods. And also another defining feature in this literature is that they always rely on something that's called the shift share design. And shift share designs are a specific way of constructing an IV estimate to overcome the endogeneity. And it's actually, since these papers have been published, there's been quite a bit of sort of like theoretical econometric work showing that shift share designs actually impose quite strict assumptions on the underlying data generating process, and it's far from clear that these assumptions are maintained in all these papers. I'm just mentioning two, but there's actually probably 24 more in addition to this. At the same time, I don't want to shit on this literature too much, because what I'm going to show in a minute, that actually many of my results are going to be quite strongly correlated with the findings of Hummels and others. That's 2014 AER paper in particular. There's only a handful of papers that really study trade in services, which is what I'm looking at here. So we have, and actually, there's 4 papers in that I mentioned here, and 3 out of the 4 actually don't really have any proper econometric identification, in the sense that they would have they would do any serious work in trying to identify trying to overcome the endogeneity of the possible choice of the possible offshoring decision. So in particular, the Amiti and Wei papers, they have this sort of like a system GMM thing, where they just look at sort of like whether offshoring in T0 is correlated with lag productivity or something like that. And in Crino 2010, it's sort of like a macro labor paper, who quite explicitly say that we're just assuming that the choice of offshoring is exogenous. The Kovac 2021, they're actually more sort of like it's one paper that to me passes the muster of sort of like econometric identification, and they use like certain changes in tax rules that made it more difficult for multinationals to bring in intermediate to sort of like lower their total tax rate by bringing in parts of the production process from abroad. So again, this is a very specific local effect for the multinationals that bring in that offshore parts of their process to their foreign subsidiaries. The Hubbles and others in the first point, again, it's a very specific local effect that only concentrates on the trading goods, the kinds of firms that are exposed to international trade. And actually, what I'm going to show in a minute, in my data, it's like probably like close to 40% of companies are in services, are in financial services, are in retail. So that offshore services are in those sectors that are not really exposed to international trading goods as such. But generally, the finding in all of these papers I mentioned above is that offshoring is associated with shifts in employment towards higher educated workers, while also increasing the high educated workers' wages. The total employment effects are kind of like, depending a bit on the paper, you might find something that's positive or something that's negative or something that's close to zero. So like the takeaway is that we generally tend to find that that offshoring is skill biased towards sort of like high skill workers. Yep. So why is it interesting to study services offshoring specifically? I already mentioned, the digital economics group. There's increased digitization this is strongly linked to increased digitization of kinds of processes in the workplace. So that's, I guess, one additional point of interest, at least to this group. Moreover, there's much less legalistic friction. So main reason why there's been so much, one of the underlying reasons why the trading goods globally has grown so much is that we've had the big developing countries joining the WTO. China joined in 2001, India joined in 1995, Bangladesh joined in 1995. So suddenly we have loads more countries with relatively low wage levels producing stuff that we in the global north can use as intermediate goods. But these rules don't really apply to these WTO rules don't really apply to services offshoring, because no physical goods cross any borders. So in theory, one could have offshored their like whatever IT infrastructure already back in the 90s before you could have outsourced I could have outsourced a part of some of my service to China, even in the 90s, and WTO wouldn't have had any complaints about that. The issue would have just been that it would have been quite difficult for the Chinese worker to supply their services to me if I'm based here in Finland, in the absence of digital technologies that enable that. Moreover, the arbitrage opportunities, meaning wage differences, are often quite a bit larger than for goods. So, for instance, the going rate for a coder in India might be less than 1/10 of what the hourly rate of the same coder is in the US, in Silicon Valley, for instance. So there's huge effects, huge opportunities for skills arbitrage. Moreover, there's also the fact I already kind of mentioned this, that trading goods has, when the developing world joined the WTO in the 90s, early 2000s, then the trading goods, like, it created a huge surge in trading goods, but trade and services has grown much more slowly. So it's much more slow. It's still much smaller than trading goods, but it's grown more rapidly, even up until the pandemic. So the latest statistics I've seen for trade and services, they still sort of like the pandemic hardly made a dent on the growth rates. Yeah, we mentioned the fourth point, that COVID-19 pandemic and digitization might have increased the growth rate in services offshoring. So what's just very quickly sort of like showing a preview of the results. What I find is that I use I use a synthetic control type of an approach to compare offshoring firms to non-offshoring firms. And then I do it separately for low and high skilled workers and low and high skilled types of offshoring, the tasks that are being offshored. I find that offshoring results in substantial reduction in employment while creating a moderate increase in wages. Also, the employment share of high educated workers grows a bit more, but I guess the most interesting thing is that it actually takes years for these things to pop up. So it's not something that like immediately appears, but rather it takes 5-6 years for me to see any effects in the data. So it's actually, especially with regards to the employment, it's kind of easy to miss these things because the lag between the offshoring decision and the actual employment outcomes takes so long to pop up in the data. As I mentioned, I use synthetic control, which is an econometric method for creating a synthetic control unit that resembles that has sort of like a similar pre-treatment trends to the treated units. But I use a variation of that's specifically developed for microdata. So what I'm going to do next is I'm going to review synthetic control, and then I'm also going to review the version of synthetic control, which is called microsynth, that I use in this paper. So this is from Abadi 2010. In his paper, he studies the effect of indoor smoking bans in California. They apparently California banned, the state of California banned smoking indoors in 1989. So what they do in that paper, they form a synthetic California that's a weighted average of other US states that are close to California in terms of their pre-trends. And so basically how the synthetic California is formed in their case is that they estimate weights for the donor units meaning states that are not California, that the states are, the donor units are weighted in a way that their per capita cigarette sales prior to the California law change are as similar as possible. So kind of like you see here on the graph on the right that the synthetic California and the real California sort of like follow each other quite closely up until the point when the smoking ban is introduced. And that point, the real California, there the cigarette sales goes down even faster than in the synthetic control unit. So basically here the treatment effect, the yearly treatment effect is just defined as the difference between the two curves, the dashed one and the solid one. In my data, what I'm going to have is I'm going to have several of this time series. Instead of a single time series, as in this case, what I'm going to have is I'm going to have several time series, and I'm going to form the synthetic control unit in a way that my pre-trends between the offshoring firms and the non-offshoring firms are going to be matched across all these different moments, so that they're like the pre-trends in all outcome variables are going to match. So in microsynth, which is this method was introduced in 2017 in Journal of the American Statistical Association by Robbins, whose first name I just forgot. But nonetheless, it's adapted to situations where, like, you know, in the previous slide, the potential donor units were the other US states. So what Abadi ended up with is a setting where the synthetic California is actually like 50% Nevada and 25%. So it's actually roughly 4 to 5 other states, and 4 to 5 other states that get a positive weight and the others get a 0. But in my setting, where I have hundreds of treated units and thousands of potential controls, this gets a bit unwieldy in terms of estimation. So instead, if you were just doing it one by one for each of the treated unit, it would be rather complicated and time consuming, and also wouldn't be the most efficient use of the data. So instead, what Robbins and others do, and what I also do, is that first I replace in the previous slide, we only have one treated unit, one California. Here, what I'm going to do instead is I'm going to replace the one treated unit with an average of all treated units. And the treated units are going to be firms that started offshoring in a single year. And then the second point I tried to already explain, which is that instead of a single outcome variable, which was cigarette sales in the previous slide, I'm going to use several outcome variables. So there's going to be wages, employment, capital stock, labor productivity, share of high skill workers, etc. And then moreover, since we're in a data rich environment, I don't want to end up in a situation, we don't want to end up in a situation where we have 1,000 potential donor units, potential control firms that all of them get a small positive weight. So that I'm going to end up with a model with 1,000 parameters. And on models with 1,000 parameters, that what tends to happen with those is that they tend to produce unstable results, in the sense that all the estimation uncertainty in each of the 1,000 parameters, they sort of like compound up. So what happens is that in the end, my predictions would have a huge variance. So instead, what Robbins does and what the microsynth algorithm does, there's an alternative way to minimize the distance between the donor units and the control units and the treated units, which enforces a sparse solution. And the solution is sparse in the sense that it minimizes the number of control units that get a positive weight. So in my data, okay, I'll get back to the sample sizes in a minute. So then this will probably be clearer. But nonetheless, it's important to sort of like one thing that sets microsynth apart from many of the other synthetic control estimation algorithms is the fact that we always end up with a solution that only has a very small number of donor units with a positive weight. My data, there's a Eurostat survey done in many European countries in 2011, including Finland. The response rate is close to 80%. They did quite a bit of things to ensure that it's representative. So there's a variable, there's a survey variable which asks that, did your firm start offshoring some of its activities outside of Finland during 2009 to 2011? Plus, there's also info on the type of task that's being offshored. So you could think of like after sales, logistics, IT, R&D, core functions of the firm, etc. The fact that the question asks, did you start offshoring between 2009 to 2011. That's a little bit problematic. So because now I would rather have the offshoring variable so that it goes from 0 to 1 in a single year, but now I have sort of like 3 potential years when it can turn on, when it can turn from 0 to 1. So what I do in the empirical part of the paper, I actually set it so that if the firm answers yes to this question, then their offshoring variable is going to turn from 0 to 1 in 2011. I'm just going to assume it's always happening on that year. And I'm also, and then I will do some robustness checks to show that doesn't really seem to matter which year the exact offshoring takes place. Then I also have access to firms' financial statements annually and linked employer-employee data, and I use that to calculate the share of high-skill workers and the average wage bill for the high-skill and the low-skill workers. Here are my sample sizes. In total, there's about 1,600 observations. Something that's a little bit difficult in the synthetic control method is that I need to have complete observations. That means that I can't have missing values in the middle. So for a company, so in my data, so by complete observations, I mean that I have observations for all the variables for all years between 2003 and 2019. And this, for instance, if there's a company that was only founded in 2006 and then they started offshoring in 2011, then I would miss that. And I would also miss companies that are, you know, that are founded that immediately start offshoring their services. So it's really about, so what I'm really looking at how the research questions formed is that I'm looking at companies that switch from non-offshoring to offshoring during their lifetime. About 20% of the firms say that they began offshoring in 2011. And most of those 21%, they say that they began offshoring some high-skill tasks. It's only a small minority that say low-skill tasks. Why these 3% don't add up is that there are some firms that started offshoring both high-skill and low-skill tasks. Here also the survey has a question on what types of tasks they offshore and what the skill requirements for those tasks are. So here's the classification that I get from the survey. So basically, high skill requirement tasks are what you would expect: core functions, IT, engineering and R&D, and low skill tasks are after sales, admin, and logistics, or sort of like cargo handling. How the estimation proceeds is that I basically, I might have already mentioned this, but it's worth repeating. I'm doing a comparison between between the average of firms that start offshoring in 2011 and the synthetic control unit. That's a weighted average of the firms that did not start offshoring. And I match on, here are the set of variables that I match on. I'm matching on capital stock divided by labor, then labor productivity estimate from a standard Cobb-Douglas production function, and the kinds of sort of outcome variables that I'm interested in. They're high skill and low skill average incomes, and the share of high skill workers, and the amount of full-time equivalent personnel. And I already mentioned that I use complete observations from 2003 to 2019. The identification assumption is that in the absence of shoring, the outcome variables of the offshoring firms would have evolved as in the synthetic control. And if it's the case that the offshoring firms are somehow systematically different to non-offshoring firms, then I argue that the synthetic control method tackles this, because like my synthetic control unit has exact same pre-trends on all the variables that I match on. So there are no differences between the two in the pre-period. So in the sense that if there's something that's systematically time invariantly different between the treated and between the offshoring and non-offshoring firms, that would be washed away by the synthetic control weighting. But still, another thing that might happen is that there's some sort of reverse causality. So for instance, there's a shock to one of the outcome variables in year 2009, and that would then result in the firm's decision to offshore its services. So then I can at least partly tackle this by splitting the pre-period into two parts. So like early pre-period that I use for matching, and then late pre-period that I use for validation, that I just use to show that there are no visible shocks in any of the outcome variables. Moreover, since this is not a panel, my control and outcome variables are not a panel, but my treatment variable, it's only from a single cross-sectional survey. So it could be the case that some of my control units, they start offshoring their services in 2016, for instance. And this is a problem then, because it would lead to me underestimating the effects. If some of the comparison firms are also offshoring firms, then that's an issue. So what I do to mitigate this problem, there's a line in the financial statements that's called purchases of external services by year. So what I do is that I filter out the firms in the control group whose purchase of external services variable goes up by more than 50%. And this will filter out, most likely it will filter out all the firms that started offshoring buying some offshore services after 2011, but it will also filter out firms that might have, for instance, started buying outsourced services from within Finland as well. So it turns out to be quite aggressive in terms of data filtering. I end up losing quite a bit of data, but nonetheless, I'm going to show later that my results are largely invariant to this filtering. Okay. So I'm gonna show my baseline results, and my results are always gonna look like this, these graphs. So here on the left of the sort of like the red dashed line, that's the time where so the blue line is the difference between the offshoring firms and the synthetic control firms, and the matching algorithm or the synthetic control algorithm works well in the sense that always the pre-treatment periods difference, it's sort of like up to a numerical precision always 0. And after 2011, some divergence starts happening. The kind of like the gray lines, they're calculated using randomization inference. So basically what I do is that I randomly, instead of comparing the offshoring and non-offshoring firms, I randomly allocate the offshoring dummy to some subset of the firms, and I repeat it 1,000 times, and then and re-estimate the model. And each of these sort of like gray lines is one realization of this this estimation, and then I can compare the actual, what I actually observe when I use the actual offshoring variable. I can compare it to these randomization draws, and the sort of like the black dashed line here, that's the 95% confidence interval for the 95% quanta. The 95% of the randomization draws are between the black dashed line. So this means that if the blue line doesn't go outside of the black line, then the difference is not statistically significant. So here, first, the way you read these is that I have these two sort of like background characteristics that I match on, which are capital stock and labor productivity, and neither of them basically I don't find any statistically significant difference between the offshoring and non-offshoring firms, which kind of suggests that at least in these dimensions the matching seems to work rather well. And then moving on to actual results, here's the effects on wages. So what basically happens is that after around 3 years or 4 years, the offshoring firms, the average incomes for both high skill and low skill workers for both of these the average incomes for both high skill and low skill workers, they grow faster than in the synthetic control group. And it's sort of like they stay high. So one thing that's striking and actually goes in contrast with some of the previous findings made by others is that there's no skill bias in incomes. It's actually the case that the average incomes of both high skill and low skill groups, they seem to grow closely, almost in tandem. And this might be due to the fact that services offshoring is different from goods offshoring, where most of the previous results come from, and also the fact that this is Finnish data, and Finland, highly unionized country, strict collective bargaining. So if there are raises to high skilled workers in a firm, it's most likely the case that the low skilled workers in the same firm would also demand a raise, or rather their unions would demand that the wage growth is roughly similar. Moving to employment, FTE personal, I show that. So that's I show that after 6-7 years after the offshoring decision, the offshoring firms, they employ almost 20% fewer workers than the non-offshoring firms. So this is actually quite a stark difference. And I also find that the share of high skilled workers is slightly higher than the share of high skilled workers in the offshoring firms is slightly higher than in the non-offshoring firms. So this is my main results. Now, what I'm going to do next is I'm going to show some sensitivity analysis that sort of that kind of that are kind of like the standard sensitivity checks that one should do for synthetic controls that's taken from the literature. I'm going to show that most of these things sort of like suggest that what I'm capturing is not some sort of an artifact of the estimation method, but it's actually capturing what I claim it is. So first, one thing that folks who do synthetic control, what they suggest checking is that do the control units make sense? In the case of I showed the California graph in the beginning. In that graph, what in that paper, what they actually showed is that it's sensible that the synthetic California donor units were made made sense in the sense that they were the units that were close to California, that has had sort of like similar legislation, otherwise had similar tax laws with regards to cigarettes. I don't see, in my data, I only have anonymized data of firms. I can't really go and see whether, firm A and firm B, an offshoring and offshoring firm, whether they're like, to what extent they're like reasonable matches to one another. But one thing I can do is that I can look at the synthetic control and the offshoring group and what their industry distribution is then. And here I plotted it, and basically what I find is that the two, they follow each other quite closely, with the exception of group C, which is manufacturing. In all the other groups, actually, the synthetic control and the offshoring group, they're like statistically not significantly different from one another, their shares, I mean. And if I test it jointly, then also the difference between, or rather the variance in this group C is so big that the variance in this group C is so big that it actually, if I test the differences jointly, they're not statistically significant either. So that's, at least to me, that's quite a promising sign. I mentioned that here you also see the biggest offshoring groups there. In addition to manufacturing, we have G and J and K. And this is G, if I remember correctly, is retail. And one of these is financial services. The other one is information services. So these are all sort of like services jobs, and the kinds of paper, these are all services sector firms in these industries. And the kinds of papers that only look at trading goods and call that offshoring, they would miss anything that's happening on those sectors. So in that sense, I believe that by doing it this way, I provide a more comprehensive view of the actual offshoring that's taking place in the economy. Then another thing, I mentioned the fact that I mentioned the fact that that the offshoring variable it's formed by assuming that the offshoring always takes place in 2011, whereas actually the question asks whether the offshoring took place between 2009 and 2011. So what I do here is that I only do the matching up until 2009, and then show that actually the results that I get, they're qualitatively very similar and also statistically very close to one another. The difference between the treated and the control units never like statistically significant in these 3 early years. And then this exercise also has some other benefits. So first of all, I mentioned the fact that I might still be vulnerable to reverse causality. So if it's the case that if there would be some sort of a big shock to one of these variables prior to the offshoring decision that would have caused the offshoring decision, then that would bias my estimates. But I failed to find any here, like in the sense that my the difference between the treated and control units is always sort of like statistically insignificantly different prior to the offshoring decision. So there have been no shocks that could potentially drive the offshoring decision to any of these variables. The any of the outcome variables that I'm looking at. And moreover, as a slightly more technical point, I mentioned the risk of overfitting, or the idea that since I have a close to 1,000 potential treated units, if the case that I actually estimated 1,000 parameters, then that would result in a very complicated model, which would have a huge variance. So if that's the case, then the fit in these pre-treatment years should be poor. But it's actually, when we just look at them visually, it doesn't seem to be the case. Again, the difference between the treated and control group, the actual estimates, the actual estimated numbers, they're very close to the ones I showed earlier. I have a table on this later, so you might not, to make it a little bit more make it a little bit easier to actually see that, to do a comparison. But you just have to, for now, you just take my word for it that they're very similar. Okay, so here's basically what I showed. The two numbers are kind of like, the two estimates are qualitatively very similar. The number in brackets, it's not the number in brackets, they're not standard errors, because I don't know, because I use randomization inference. I don't have a good way to do standard errors. Instead, that's just the p-value calculated from the randomization inference. Then I separate by high skill and low skill offshoring, and what turns out that it's actually, the results seem to be driven by high skill offshoring, probably because there's just so much more of it. The effects of offshoring low skill tasks, they're always pretty close to zero, which could just be an artifact of low statistical power. But nonetheless, you kind of like see that my results, they're driven by high skill offshoring. And then okay, here's the point I mentioned earlier, the leaky control group, which is that some of the potential control units, some of the firms that did not start offshoring in 2011, they might start offshoring at some point later in the data. So this then leads to some of the control units actually being treated units, and which would then lead to providing too small estimates for the effects of offshoring. But what I can do is that there's in financial statements, there's a line called purchased external services, which includes offshoring, but also includes outsourcing, might also include some one-time expenses, such as I don't know, moving to a bigger moving the company office to a bigger building or something like that. If they use the moving company, then probably the moving company would be, the expenses of the moving company would be in the external services line. But so it's something else. It includes other things in addition to offshore services. But nonetheless, what I do is that I filter out firms whose external services per worker have grown more than 50% of any time after 2011. I exclude them from the donor pool, and then I redo the analysis. And basically, again, here this turns out to be quite the effect on sample size is actually, I end up filtering out almost half of my sample doing this, but even then, if I filter out almost half of my sample, I get, again, results that are qualitatively very similar to the main estimates I showed earlier. So if anything, this seems to confirm my main estimates. So in summary, using synthetic control, I find that offshoring firms in the long term, they pay slightly higher wages to both high and low skill educated workers. They employ relatively more educated workers, and they also employ quite fewer people, quite a bit fewer people, almost 20%. This is consistent with sort of like the standard workhorse model of offshoring in an international trade. Offshoring of services is Grossman, Rossi, Hansberg. And in their paper, they basically, what they do is that they assume a constant elasticity of substitution production function, which means that they assume that if a firm is offshoring high-skilled tasks, then offshore high-skilled tasks are going to be complementary to high-skilled tasks done at home, which will then lead to share of high-skilled workers, labor share of high-skilled workers increasing, and the wages of high-skilled workers increasing. This is again, so basically, again, this is by assumption in their model, but actually, it turns out that without imposing any structure to my estimation, I actually end up with something that's consistent with their theoretical models. And so this seems to be, so their model seems to be a good way of understanding what's going on, even in my data. Okay, this is my last slide basically, where I just note that first, the effects take a long time to appear, and this is, since they take so long time to appear, they're easy to overlook. So it might be the case that instead of a mass layoff taking place in a firm, what happens is that some people retire, they're not replaced, slightly fewer people are employed, etc. But that adds up to quite a bit, up to 20% in the long run. In the short run, actually, most of the estimates, if I just look at the short run, like, up to 3 years or up to 2 years, most of the estimates I showed, they're like, very close to zero, both qualitatively and in terms of statistical significance. The magnitudes, what I find, they're actually quite comparable to the results that others have found for trading goods, which seems to suggest that there are similar mechanisms are in effect when one is buying cheap goods from abroad compared to when one is buying cheap services from abroad. Then something I didn't highlight because it's I'm still a little bit puzzled by it, is the fact that if you look at the effects on labor productivity, it's always like this. I never find anything on labor productivity. And this is like, if it's the case that offshoring is beneficial to the companies, which is presumably why they're doing it, it should, and it decreases the employment within firms, it should increase the productivity of an individual worker. And I failed to find that, and that's a little bit puzzling. So there are a couple of explanations for that. So first, I'm just using a Cobb-Douglas productivity, which is probably a slightly too simplified version. Which is a very simple way of measuring productivity. And if I was doing something, if I had longer data, and if I was doing something more complicated, I might be able to find something. But then if I was doing something more complicated, then that would be incompatible with the synthetic control setup I have here. So I'm forced to do something simple. If I do TFP instead of labor productivity, I also get something that's very, very noisy. So probably what's more likely going on is that the effects on productivity are so small that, and the productivity in itself within firm there's so much variation in it that I failed to capture the effect, or my estimation method fails to capture the effect on that. And then the third thing, my data, my offshoring variable is from 2011. The offshoring decision that the firms made that took place in 2011, that's already quite a long time ago. It's not clear to what extent that to what extent these findings generalized to other time periods, where, for instance, different types of things are being offshored, different types of services are offshore, different types of firms are doing the offshoring, etc. So in that sense, this is very much a study on what happened, the effect of offshoring decision in 2011 on outcomes in 2018. So it's not entirely clear to what extent these findings generalized to other time periods. And what makes it more difficult is there actually has been a new wave of the global value chain survey that was done in 2019 or in 2020 actually, asking from years 2017 to 2019. But the issue there is that if it's the case that these effects take so long to appear, I won't be able to find anything if it's the case, even if it's the case that the employment effects are big. If it takes 5 to 6 years to see anything in the data, that time still hasn't passed, so that we're stuck with looking things that happened earlier in the past. Finally, oh yeah, so one more point that I'll mention before I conclude, before I stop, and that's that actually my results are very much consistent with qualitative offshoring studies that are done by management scholars. They basically find that when a firm makes an offshoring decision, it's a risky decision. In addition to offshoring, they need to invest in hiring the kinds of people who can work with offshore talent, setting up the kinds of monitoring mechanisms, and investing in the kind of capital that's consistent with bringing in offshore services to the core production of the firm. And all these things, it takes years to set up, and they kind of need to do it by trial and error, by investing into something and then figuring, oh yeah, this doesn't work, maybe we need to do something else. So then in that sense, it's not surprising that any effects that offshoring has takes quite a long time to appear. So, all right, thank you. Now you have any questions? I hope now if you have any questions, I'll be happy to take them. Thank you.